Good afternoon. We're joined here in New York by Kevin Greene, Managing Partner at James Alpha Management. Kevin, thanks for being here today. Perhaps you could touch on your background before we begin.
Sure. So nice to meet you, George. Nice to be here. So my background is always go back in ancient history as a management consultant with McKinsey Company. Then decided I should start a boutique investment bank. Did when I was 28 years old. Concept then was that at that time in 1990, continental European money managers did not invest very much in small mid-cap U.S. companies. So I decided I should create an institutional quality research product. Went barnstorming around Europe with a bunch of other young people, and managed to do pretty well. I was like sharing this with people. We were doing 50,000, 100,000 share blocks of stock, making markets in those stocks. And back in those days, I used to say to people, if I only got paid 20 cents a share, I was insulted. So third month of business, we did $500,000 in revenues, 4 employees. That's called the good old days. And that firm, I'm proud to say, Bryant Park Capital still exists, more than 30 years later. But I did that for about 10 years, exited, and then did a roll-up of pension consulting firms here in the U.S., put 4 firms together. It's called CRA Rogers Casey. And when I exited in 2004, we were advising $500 billion in institutional assets. And then met a gentleman who had built GE Capital from 10% pre-tax profits to 2/3 of GE's profits by the time he left there in 2003. Then we had private equity at Oak Hill Capital, which he grew from $4 billion in assets to about $16 billion. And we met in 2004. 2006, he asked me to create James Alpha Manager, create a family office for him. So I've been doing that ever since, and we've had a lot of success together in growing his wealth.
Excellent. And so with your work at James Alpha, where do you typically allocate in the private markets?
Sure. So let me just start with overall asset allocation. So it's a big part of the portfolio that we call preserve and grow wealth, and that's almost entirely the public markets. A lot of it's hedge strategies, and that's compounded about 8.5% per annum. And the main thing of that strategy is to be very liquid and perform well in down markets. So in 2022, as an example, when the equity markets were off 30%, the bond markets were off 17%, worst bond market in the U.S. in 150 years, we were flat. So that's what that strategy is meant to do. So once you got that, and that's grown, you compound 8.5% over 20 years, you do pretty well. So with that in line, that allows us to then invest in private equity, which can range from investing in funds to investing in individual companies. So with kind of the base extraordinarily secure and growing, we can take more risk with the rest of the portfolio. So that's how we think about it. And when it comes to investing in private markets, so my job is to look at everything. So I get shown opportunities all the time. But typically there's some kind of a theme that we want something happening macroeconomic-wise that we want to get in front of or benefit from. And so we just go and try to figure out ways. So sometimes things just are presented to us, somebody has a good idea, good quality people, and we decide to back them. In other cases, we like an area or sector, and we say, how do we express that through a particular investment? So, but it's very, very broad, very opportunistic.
Interesting. And so with that quite opportunistic thesis then, how are you vetting and diligencing an opportunity, let's say from the first solicitation, the first glimpse of something? Yeah. What are the first sort of green flags you're looking for? Say you have a macro thesis that you think that this might be part of.
Yeah. So first, does it fit criteria we're looking for? But most importantly, it's always about the people. Yeah. So we're looking for talent, integrity, and alignment of interests. So talent, they either have a proven track record or they don't. Integrity, they either have it or they don't. And then track record. Have they done something in their past that demonstrates to us that they're likely to repeat it? And when it comes to whether it's funds or individual companies, we actually, like a lot relatively young folks who have a track record and we believe are going to continue to perform for 10 or 20 years. So that's the first cut. And the second cut is that we take a view that we're really don't know that much. We're not terribly bright. We're generalists. So find something we like. We then try to identify what we describe as somebody in that space who's forgotten more about the space or that sector than most people will ever learn in their lives. And so we go to them and say, what do you guys think? If they like it, then we're likely to get a lot more interested in it.
Interesting. So there's some third-party validation that you guys do as part of that
Super
process too.
important. Yeah, super important. Obviously.
How should a company best approach? Let's say they want to raise equity capital, and they want to make sure that the diligence you do ultimately leads to an investment. Is the best route for them to work with an investment bank and approach you through a trusted channel with their data room, their materials all in place? Do you prefer more of an informal outreach? How do you think about things? When you're being pitched opportunities on a daily basis, how do you vet the ones you discard immediately versus the ones where you say, hey, I'll take an extra 10 minutes and really look through this one?
Yeah. First of all, the first cut of taking an extra 10, 20, 30, 45 minutes, that's easy. I'll do that with almost anything that has some basics to it. So that's not the hard part. Well, as an investor, the way you look at it is, I want to see something where the only one looking at it or relatively little competition, right? Selfishly as an investor, that's what I want. And if a company's, if a company or fund, everybody wants to raise capital, obviously they should have their act together, right? They should have a data room, they should have a CFO, they should have a business plan, they should have all the financial controls in place. But even having said that, that doesn't matter so much as do they have a really good idea? Are they credible in terms of talent and integrity? And are they, the alignment of interests, I didn't talk much about that. They have to have their own skin in the game. If they don't have their own skin in the game, why should I, right? And that's more than just, I took a pay cut to do this. Well, that's good. I'd like to see you write a check as well. And I can tell you where they write a check, no matter how large, when it comes to a fund manager, for example, they don't have most of their investable wealth in that strategy. I'm probably not going to be interested because most people really believe in themselves as money managers, say, I'm the smartest person on the planet. I get better returns than anybody else. Why would I ever give anybody else any money? So when it comes to fund managers, that's what we want to see. With a CEO of a company, something similar, we really want to see them with skin in the game. It really matters. And it's got to be meaningful for them, right? For some people is a couple $100,000. For other people is $10 million. They get scaled to kind of their wealth in life. So that alignment of interest really, really matters a lot. But you were asking, so it really matters. Is the idea good? Are they talented people? Can they attract talented people? Can they attract great customers? That's what matters most. As an investor, I want to be the only ones who have met them, right? I don't want them to have hired an investment banker, just to be honest. Now, with my hat on as an investor in a company wanting to go out and raise capital, in spite of the fact that myself and the family office and my colleagues have a lot of relationships, I'm a big believer in hiring an agent to help out, to help you get organized, to actually create a competitive market for that opportunity. I think it's really important.
Makes sense. Great to get an idea of your priorities on what you look for in founders and investment opportunities. Yeah. On the flip side, what are some pitfalls that founders should avoid when looking to raise capital? And maybe you could speak to one or two situations where diligence has been going well, and for whatever reason, the founder put you off. Basically, the discussion was finished at that point.
Yeah. Well, it didn't work. It's just not a good fit for some reason, right? It could be we decide they're really not very good. Could decide, no, we don't like the strategy. Could just not fit. It could fall apart for a number of reasons. First part of your question, actually, I was more interested in, which was
pitfalls that founders should avoid.
Pitfalls they should. Well, yeah. The most important, and this is where I've got both my investor hat on and my investment banker hat on from those days. I used to always say to people, So if you need labor, materials, and capital, right? So labor. If you need a legal job done, you hire a lawyer, right? You don't hire a bottle washer. Okay, got it. So both, so you think hard about that. Then when it comes to, whatever raw materials, right? If you are building a wooden house, you need wood, right? Makes sense. Then when it comes to raising capital, people they just go, well, any capital doesn't matter, right? So the kind of labor you choose matters. The kind of raw materials you choose matters. And when it comes to capital, actually where it comes from actually matters. Yeah. But it always struck me as amazing that people just all that thinking goes out the door. So I'm a big believer that, having the right source of capital really, really matters. Okay. So what does that mean? Yeah. Do they really understand your business and your strategy? Now, I'll say this, caveat a little bit. Yeah, you can always just take anybody's money. No problem. That'll work, right? But to the extent you can get it right, really finding investors who really can add value, are really engaged, really, really matters. So to the extent you're raising capital, thinking hard about that, because that can make a big difference to the company. So I'll loop that back to due diligence. I like companies that have some kind of board of directors, and then who's on that board of directors really matters. Okay, the cousin, the uncle, the wife, no. That's because what is the board there to do? A board is there, and people really underestimate this from a due diligence standpoint. Most people get it. It's something people don't pay attention to, but they should. So, example, no board of directors at all. Okay, well, that really means that person that representing that company better be the right one because you had no recourse, okay? So I prefer to see a board of directors. And that board of directors, are they accomplished individuals? Are they highly professional? Because their job is to make sure that the CEO and the business is on the right strategy. They have the right resources, the right capital, and the right human resources, and whatever else they need. But most important is when things go wrong, right? Are they going to actually be able to help the CEO or change the CEO, right? And that's really important. So that's something that we scrutinize a lot. Or we get involved in companies, we'll join the board, we'll help create a board. Because I can tell you, if your goal is to really build a great business or company and ultimately exit, if you don't have a high quality board, it's less likely to happen. In fact, it won't happen. If you have a conflicted, biased, corrupt board, you're really going to have problems. Run away. That's definitely run away if it's the wrong entrepreneur. Run away if the money has the wrong goals. Run away if it's the wrong kind of board. So those are definitely knockouts.
Yeah. Can you touch more on, and I think you touched a little bit in your answer, the difference between the right capital versus the wrong capital? Yeah. Can you touch on the differences between family office capital and family office investing versus traditional venture or traditional institutional funds?
Yeah. So I'll start with the first question. A little bit maybe might be cynical. I think most private equity and even most venture capital funds don't really add any value. I mean, they all say they do. I actually don't think they do. But there are some that do, and those are worth a lot, going back to my first construct. So picking that really carefully. And a lot of times it's just, if you're the entrepreneur, you're the person building this business, do they really understand what you're doing, right? But from a due diligence standpoint, I'm jumping around a little bit, but bear with me. We put companies through a lot of due diligence, pretty tough due diligence. A lot of people do. And it's a vetting process. So a high-quality entrepreneur or fund manager is really on top of the game. When you really drill hard on due diligence, the really good ones, no problem. They respond like this. Very on top of things, and the ones who don't, another red flag. They're either unprofessional or incompetent, right? Or maybe dishonest. But, we don't, due diligence, we believe only, nothing that we hear and only half of what we see. So we trust but verify everything. And again, the quality players actually welcome the scrutiny. They like the transparency, and so they kind of self-select. Okay, now between, let's say, the typical private equity or growth venture capital investor, a family office, I've often said that there's this misconception in the world that like family offices, it's kind of like dumb money and they don't really know what they're doing. And granted, there's a lot of dumb money out there. By the way, there's a lot of dumb money in the professional world too, but be that as it may, most family offices are of any scale that can put any real capital to work, are very sophisticated. They're usually former entrepreneurs. So they're actually bringing operational expertise that pure financial players don't bring to the table. And they typically hire talent, either internal or external, to vet things. So, I would just caution people not to go at it thinking that it's like easy or whatever. It's just different. It's really just different. And everybody has their own vetting process. One thing you'll find in both worlds is that everybody has their kind of constellation of people they rely upon. In the private equity world, tends to be other private equity funds. And in the family office world, quite often you kind of get to know a family office and go, like, this guy's really smart and that guy's not quite as good, but so this guy wants to do it, I'll do it. And so all that stuff goes on as well. And then a family office just has probably the most important criteria is they definitely have a different time horizon. There is no time horizon, typically. They have a longer time horizon, whereas funds have a very, very well-defined time horizon. But again, it's, a large private equity fund will have a lot more resources than a small one. And a large family office will have a lot more resources than a smaller one. So all that stuff is pretty much the same. And just family offices are typically have some particular need they're trying to fulfill. And if you go out and raise money, make sure you find out what that is early on. I think the biggest problem for folks raising money is, meetings are easy. They're cheap. A lot of times people are just kicking tires to kick tires. So, getting, and this is what a good investment banker does, is, getting to, are these people serious or not, as quickly as possible is really important because people burn a lot of time.
Mm-hmm. Certainly. And you've sat on both sides of the table, right, throughout your career. On the fundraising side, then, what's been the best approach that you found, maybe a few words of wisdom around taking from that initial meeting and running a smooth diligence process actually as a founder?
Yeah. So it's a company we're investing, we're going to raise money.
Yeah. So you go out to raise money.
Yeah. So I'm a big believer in hiring investment bankers to help you do it, making sure you're in good shape, and then running a disciplined process. So we've even had an example where we had a buyer, had a good price, and we liked it. We still hired an investment banker. And we ultimately sold to that buyer. But it communicated to that buyer that there was other competition. First of all, it communicated that we were going to run a professional process, even if we were just selling to them, and then that there would likely be competition if they didn't kind of behave. So it created behavior. Another thing that I highly recommend to any private company is, if you want to do it right, if you're running a private company and want to do it right, first of all, that company should do their financial reporting every month, then 5 or 10 days at the end of the month. If they can't do that, then they're not disciplined. The other thing I recommend is maintain a data room as if you're going to sell the company the next day. Sure. Okay? Like really maintain a data room all the time. Because what that does is that when you hire a banker, a lot of that is done, but a good banker helps you do that. The other thing is when it comes to, reps and warranties and holdbacks and all that, where I want to be is in a position where I go, wait a minute, look at our data room. We've got audited statements. We've got all of our minutes. We've been doing this since inception. What information are you lacking? So it really reduces holdbacks and all that kind of stuff. Because we go, what do you mean? It's all right here. It's been here forever. Not every company we're involved in is able to do that, but the ones that are, we're in really good shape.
I suppose the broader theme there is around really just being ready to stand up to pressure testing, right? And being able to run a disciplined process with clear communication and meeting timelines and all that sort of thing.
Yeah.
Yeah.
I
And
want to.
that's what a good board of directors does.
Sure.
Right. A board that has, again, skin in the game, not just, been rented.
I want to touch on a trend that we've noticed, which is where family offices might have been LPs traditionally of big venture funds, going out, eschewing that, and becoming direct investors now.
Sure.
And
Yeah.
private placements. What do you think's causing that trend, where the family offices are not, I don't want to say hiding behind, but they're going to the front lines now,
Yeah.
and they're writing the checks themselves.
They've just gotten more sophisticated. I don't know. You'll comment on whether there's more or less. But yeah, I would say if I go back in ancient history, go back 30 years ago, most family offices were not professionally managed. They just didn't do it. It's not what you did. And there's a wonderful woman, Sarah Hamilton, who started the Family Office Exchange. That was kind of her vision. And if you look at the sophistication of family offices, it's really grown dramatically. And then you have multi-family offices as well. So they're much larger. So I think as they've gotten larger, they've hired talent, they've gotten more sophisticated. I don't think it's a comment at all on the venture capital community, because they're really good at what they do. But you get large enough, you've got the resources, you can hire the talent, you can allocate the capital. Even if you talk to most venture capitals, they'll say to you, we're just taking 20 shots and hoping one works. I don't really like that approach, but that's all they're doing.
And what's the real incentive for you as a family office to do those direct investments rather than having that be carried out by a fund that you might be part of?
Right. I guess you feel that you're going to do extremely well with the investment. That's what drives it mostly. And I think if you enjoy that challenge, that's enjoyable. Just allocating to a fund is not much fun.
Sure.
You should have fun in life, I think. So I think it's just predisposition.
Yeah, and I suppose it's about being more focused, right, rather than having a spread of multiple companies that you might not be very hands-on with.
It starts with confidence that you can do it. If you don't have the confidence to do it, you should not do it.
Yeah.
That's just painful.
Makes sense.
You had mentioned being opportunistic with certain investments.
Yeah.
For a founder that's looking to raise capital, I suppose you don't want them in a position where they're too distressed that the opportunity becomes uninvestable, but equally you do as an investor want to get a good deal. So how can founders strike that balance? How do you perceive that state of affairs generally?
Well, again, I keep going on, go back to my investment banking days. The thing I would say to any founder is, if you're obsessed over the percentage of the company you're giving away, you're making a big mistake. The value of being properly capitalized today versus a few percentage points, it's not even a contest. So I'll give you an example. From experience, startup company, I was helping them as an investment banker, and I forget what the numbers were exactly, but they got an offer from a terrific family, the very wealthy family in Europe, for, I think it was $10 million at $20 million pre-money. They said, absolutely not. We get $30 million pre-money. And I explained to them, I said, okay, you realize that the difference here is, I give up a third of the company versus I give up a quarter of the company. We're talking about 8 percentage points. And you really think this company's going to be worth 5 or 10 times as much? Why does this matter to you? It's irrelevant. And sure enough, they turned down the money, and they didn't raise any money. They went out of business. So the number one thing I'd say to founders, don't get hung up on valuation. It's really not important. Unless, if you really believe in this tremendous upside, again, I'm repeating myself, gain the money today and getting ahead of that curve. Because guess what? Somebody else is going to have that idea. So getting there first is much more important. So, and I've even made that mistake myself sometimes, So it's just really, just don't obsess over that. The market will tell you what you're worth, okay? Believe them, because they're writing the check, okay? And you can have intellectual debates with them all you want. When the money hits the bank, that's what the valuation is. So that's hopefully that answers your question. That's really important. Now, as a banker, you got to do the right thing by them, and your job is to get out there and get the best price you can. But getting money today is much more important than the particular valuation.
Right, because it's not always guaranteed in the future. You might have to, if you raise it too good of a valuation, initiate a down round, or that capital may not be so readily available in future.
Well, that's the other thing. Raise money when you can, not when you have to. If they're giving you money, take it. Like, don't ask too many questions. Just go right ahead. Go and jump in the pool.
Anything else you would like to cover? Maybe we should ask.
That's a topical question. I'm trying to think if because I think it is important. I love entrepreneurs and businesses and building companies and all that sort of stuff. And if I can help people do that, that's great. I think I said it all. It's really important. It really always used to crack me up. And I remember what I said. I hire the right labor. I hire the right raw materials. Then it comes to capital. It's like, I don't give it there. I take it from anybody.
Take it from anybody,
What are you, crazy? Like, put some thought into that. Because it can make a huge difference.
That's right.
Huge difference. Like, all difference in the world. I just say that to you as young guys, Also, all those issues of, like an intelligent board will advise a CEO and help build a great company. And that's another reflection on the individual,
Yeah, it's one of the few situations where incentives are perfectly aligned. After the term sheet's accepted and after, you've maybe gone back and up on it right now.
Yeah.
You're fully on the same team. So I guess,
We'll see. We'll find out. So, if you have a crappy board, bad things happen. Bad things happen.
As well as being able to be dynamic as well. Like, you can be backed up on strategy, and then you can also be dynamic when challenges hit, right? That's the piece.
Absolutely. That's, first of all, hopefully giving guidance along the way, but particularly when bad things happen.
Yeah.
If you don't have a good board, that CEO will make a lot of bad decisions, right? They'll have nobody to turn to. Like, I'm an entrepreneur. Like, I know what it's like. You've got like this obsessive personality, and you're only successful because you're so obsessive, but you become really successful when you can listen to people, and having people around you that are talented and have integrity and have skin in the game makes all the difference in the world. They're always tough times.
Do you take a board seat when you invest?
Yeah, typically. Yep. No. If it's a big enough investment, we do a lot of things that are just, that's kind of interesting. Let's throw a couple of bucks into it and see what happens.
Yeah.
And sometimes those then become bigger things. Or I can like those people. Let's put some money there so I can, I call them, they'll call you back. Maybe not, yeah. So it's funny what happens. But then things were really very involved. Chairman, lead member, all that kind of stuff. Yeah, right. You got a lot of money in it. I'm watching it carefully.
I have to answer to you.
I got to answer to that. It's Ranji Gabo. 125,000 employees around the world.
Kevin Greene of James Alpha Management. Thank you for coming. Thank you for joining the Nassau Street team. It was a great conversation.
Thank you for having me. I enjoyed it.